Hello and welcome to the Hotel Investors Marketplace produced by Hotel Brokers International. I'm Charlie Fritsch, President of HBI. The Hotel Investors Marketplace is designed to provide the most current information in franchising, lending, and valuation, as well as provide an opportunity to preview recently listed hotels. While everybody gets signed in and comfortable, we'll highlight a few HBI member hotel listings on the screen, and I'll take this opportunity to share a few points of interest. Hotel Brokers International is the leading hotel sales organization with more than 50 hotel brokerage specialists. Founded in 1959, the organization's broker professionals have successfully negotiated more than 10,000 hotel real estate transactions and annually account for 48% of all mid-market and economy hotel sales in the United States. Visit HBI on the web at www.hbihotels.com. If at any time during the webcast you have a question, just click on the Ask a Question button found on the gray bar located at the top of the webcast player. Type in your question and submit it. We'll answer as many as our time allows. Please let us know how we're doing. Rate today's webcast by clicking on Rate, which is found on the gray bar located at the top of the webcast player. Later today, this webcast will be posted to the HBI website at hbihotels.com for on-demand viewing. Now I'd like to welcome our speaker, Steve Hennis, CHAISHC, is Director of STR Analytics, Smith Travel Research Analytics, where Steve oversees specialized consulting projects and the development of new STR products and services. Mr. Hennis has over 17 years of experience in the analysis of lodging investments. He has appraised and evaluated over 500 lodging facilities and has been involved in the underwriting, negotiation, and acquisition of over $400 million in luxury hotels and resorts. Mr. Hennis focuses his expertise on lodging investments, destination, CVB studies, and Excel modeling. He currently assists the development of Hotel Investment Barometer newsletter and the Tableau dashboards. Mr. Hennis founded Hospitium, a consulting firm focused on the upscale and luxury sectors of the lodging industry. He served as Vice President of Hospitality Investments for Low Hospitality Group and Destination Hotels and Resorts, and was Vice President and Director of Research for HVS International. Steve will be giving us his presentation of hotel transaction data for 2012. Steve, welcome.
Thanks, Charlie, and thanks for having me today. Good afternoon, everybody. Just to give you an overview of what I'll be discussing today, I'm going to start with a brief intro on the current performance metrics driving the top line in our industry, and then I'll get into more of the transaction activity and development activity that we see on the investment side, and close up with some forecasting information and our outlook for 2013. Just looking at the overall metrics through year-end 2012, you can see obviously supply and demand at our all-time highs. I think there's been a lot of press about how demand is so significantly high, but what doesn't get so much press is that supply is also at an all-time high. So obviously that's the two factors that are driving occupancy, and as you can see, occupancy at 61.4% is still a few points below what we were at peak. At peak level, we were a little over 64% occupancy as an industry, so we've still got a few points to gain there on the occupancy side, although we have seen quite significant recovery over the past couple of years. On the rate side, we're at $106 through year-end 2012, about $5 below where we were at peak. Looking at where our trends are now, we'll probably get back to the $111 level within the next 12 months. And RevPAR at $65, again, obviously with occupancy and ADR below peak, RevPAR is still below peak as well. and room revenue, again, at an all-time high with such high demand levels overall, and that's really what's driving some of the success of the lodging industry right now. Looking at RevPAR growth for the past couple of years on a month-by-month basis, you can obviously see that there's been some fairly significant growth levels, particularly in 2011, coming off of the decline in 2009 and even the early portion of 2010. That growth is slowing down primarily because occupancy is starting to get, again, closer to that peak level, and really ADR is what's starting to drive the RevPAR growth going forward. Really, supply isn't an issue at all. In a lot of segments, we see very little supply growth coming forward, particularly in the luxury and the upper upscale segments, and I'll discuss some of that looking forward when we get back into the development side of things and look at what's under construction and what's in the pipeline right now. The big segments that we see growth in are the upscale and upper mid-scale segments, which we're seeing about 1.9, 1.8% growth year over year in 2012. And the key thing here to note is that the long-term supply growth for the industry is about 1.9, 2.0%. So even at these levels in the upscale and upper mid-scale segments, you're really not seeing that much in significant growth. But what we are seeing in those two segments, really, that you're looking at the Courtyards, the Hilton Garden Inns, Hyatt Places, a loft-type products in the upscale segment, and then the Hampton Inns, the Holiday Inn Expresses, Fairfield Inns that are really the new drivers of growth in the upper mid-scale segment. And as I mentioned, ADR growth is really what's driving the RevPAR growth recovery. Early on in the cycle, and this is what we've seen in the past few cycles in terms of the recovery phase of the industry, is that occupancy builds first and ADR growth is behind it. So once occupancy recovers to a certain level, we start to see rate growth and pricing power come back to the industry and really push things forward. What we're not seeing, and I'll get into this a little later, is that ADR growth that we're looking at right now is really not as significant as one might have anticipated when you look at where we were at in the prior cycle, where we saw rate growth in the range of 7 or 8%. We're really not seeing that type of growth right now. It's really more in the 3 to 4 to 5% level month over month. And then when you look at each segment and where they are compared to their prior peak, we're looking at 2007 versus what we were at year-end 2012 here. You can see the upscale and the upper mid-scale segments where we're seeing the most growth in terms of new product is also the two segments that we're seeing the fastest recovery. Those are the only two segments that have reached and achieved their prior peak RevPAR. Luxury still a bit off, upper upscale fairly close, and then the mid-scale and economy have a little bit of a ways to go. Again, looking at the supply and demand fundamentals for the past 20 years or so, you can see that obviously supply has a little bit of a buildup and takes a little time to taper off during the different cycles, and obviously that's more of a function of the time to build and also the lending environment for new development. Looking at where we are now on the supply side, you can see we've kind of already reached that bottom level of growth, which I believe was 0.4% growth at some point in the middle of 2012, and we're starting to see a little bit of an uptick there in terms of year-over-year growth, but still fairly insignificant when you look at the significant growth that occurred in 2009, 2010, and also during the peak period of the prior cycle.
Steve, as Smith Travel Research tracks the supply growth, when do you add a property into the supply? When it opens and people start sleeping in the rooms, or is there any earlier points that you track?
We certainly track pipeline from inception, from when they start getting into the planning and development stages, and some of those may or may not come to fruition at the very end of it. But as far as when we actually add them into the supply, it's when they actually come online or are actually able to house people. Yeah, okay. Good. And then looking at the demand growth here, obviously you can see the rebound, significant decline in 2009, reaching a peak again in terms of year-over-year growth in 2011, early 2012, and we're seeing that growth decline, although it's still 3% growth year over year at the end of 2012 here. And although the demand is slowing, so demand growth is slowing, really a lot of that is driven by the fact that there isn't much supply growth in many of those markets. A lot of the markets that have recovered and have returned to their prior peak simply don't have the rooms to accommodate people. So some markets, there's still demand there that can be absorbed if there were new hotels to hold them. So there's a factor there that really isn't included here, and that's the unaccommodated demand factor in some of those markets that are probably more favorable for development in terms of being able to build hotels, but it all depends on your ability to get financing and obviously the time frame to get those constructed.
Yeah. Are you going to, can you highlight a couple of those, what those markets are, where there's the most unaccommodated demand?
Yes, I mean, certainly we'll get into that in a little bit here, but I mean, the ones that certainly come to mind are the markets in San Francisco that recovered fairly quickly, and if you look at some of the markets in like West Texas and North Dakota that are seeing significant rises in demand in terms of that are really driven by the oil industry and the fracking that's going on in North Dakota. So there's markets like that could easily absorb new supply fairly quickly, but again, it's getting those built and getting those constructed to be able to realize that demand growth. And here we're looking at again, demand growth year over year compared to ADR, and you're seeing that ADR growth is curving off to the right instead of spiking up as we've seen in the prior cycle. If you look at the time period between about 2004 and 2008, you can see significant ADR growth that occurred once we reached a certain level in demand growth. And here, even though demand is at an all-time high, we're not seeing the pricing power in a lot of areas, and we believe a lot of that is really driven by the group market and some of the major markets that are preventing ADR from really gaining momentum and being able to see the 5, 6, 7% year-over-year growth rates in ADR.
Steve, is the occupancy number the same? That's the trigger point for higher ADR growth in every market, or does it vary? Do some markets start hitting higher ADR growth at lower occupancies, or is there one magic number across the country that when it hits that occupancy, ADR spikes up?
Market by market, it definitely varies because you're looking at you'd have to narrow it down to days of the week and when those peak periods are. I mean, certainly there are some markets where there's such significant seasonality or even weekly fluctuations that occupancy levels could be extremely high, but they're driven by low-rated business. But overall, in the last cycle, once we hit like the 61.5% occupancy level, we were able to see significant growth in average rate in a lot of those markets. Here we're about at that level on the national level, and we're not seeing that growth yet, and we don't even see that going forward for the next 12 months at least, based on the information we have from forward booking data and looking at the group booking pace and things like that really are showing that the growth in rate is still not as substantial as one might expect if you were looking at it compared to the prior cycle where we were doing such significant growth rates in ADR year over year in the prior stage of recovery where we are now.
Yeah.
And here we're looking at the RevPAR growth year over year and the expanse of time in which RevPAR grew in the prior few cycles. Here we're already over 2 years into the growth cycle. And if you look at the long-term economic cycle for the U.S., I mean, certainly we were at a very beneficial period here in the 1990s and even into early 2000 as far as growth in the economy and growth in revenue per available room. But when you look at the long-term picture of the U.S. economy, on average, an economic cycle between recovery and the following recession is only 5 years. So when you think of it that way, even the 65-month period during this previous cycle, while it seemed fairly short, it was really just short in comparison to how long and extensive the prior cycle was. So looking at that, we probably only can anticipate really, 4 more years perhaps of positive RevPAR growth before, the next economic hiccup that the U.S. may incur. So I think we're seeing that to some degree in the way people are underwriting deals and being a little more careful with how they look at deals now, particularly when you look at the lender side of things and how they're doing a lot of their sensitivity analysis, assuming that at some point during the next 10 years, which is generally how long people look at when they're doing their pro formas, at some point in those 10 years, there's going to be some sort of downturn or something that causes either negative or negligible growth in terms of year-over-year cash flow. And again, just to look at the ADR growth, which is really what is the key factor here going forward in terms of how quickly we can recover and get back to the prior peak and assume positive net growth since the prior cycle. You can see that we saw such significant declines over a 19-month period between September 2008 and April of 2010, where we dropped 10% overall. And then the recovery, the next 19 months, if you're looking at an equal time period, we only grew about half of that back. So by the end of 2012, where we hit $106 in ADR, we're still below that time frame, and it is taking a longer time to recover on the ADR side, and is really illustrative of that. And here's just another way of looking at that and where we might anticipate to be in 2014, where if you're comparing ADR to where the ADR from 2000 was and how it grew according to CPI, looking at the blue line there, assuming that it grew along that same pace, we can expect that the next peak will probably be around 2015 in terms of where we see ADR getting back to, or real ADR getting back to where it was in the 2007-2008 range. So even in
keep trying to get back to the future.
Yes, and there's certainly two ways to look at this. Looking at 2000, we're looking at a peak, and we're seeing we didn't get back to that peak until the 2007-2008 range. Obviously, if you started in, say, a trough year, say 2002 or 2003, we would definitely have returned to that level if you adjusted 2002 CPI to get to, say, 2012 or 2013. So it's all a matter of how you're looking at it. If you're comparing apples to apples from peak to peak or trough to trough or recovery period to recovery period. But looking at the peak level, you can see that we wouldn't get back to the prior peak level in terms of real ADR until probably 2015, 2016. And again, just to reiterate, we're going to go through some of the chain scale data here where we break it down a little more. But obviously, as I said before, the growth levels in supply are really focused on the upscale and upper mid-scale segments, and the other segments really aren't seeing much growth at all. And then when you look at ADR and occupancy, you can see all across the board that for the most part, it's fairly similar in terms of overall growth. See a little more on the luxury upper upscale and upscale side on the higher end of the industry, because a lot of those properties were the ones that really fell the hardest during the tough period. And again, looking at it by each segment, you can see again where we are, and the upscale and upper mid-scale are back to where they were in the prior period. Now when we're getting into segments, here's where it gets a little more interesting, and you can see where some of the power behind ADR growth may be lacking. Here, transient demand, you can see in 2012, and really the thing to look at here is the purple versus the orange or the green, and where we were at peak. And each year, even during the downturn, you can see that transient demand continued to grow. Even in 2010 here, in 2011 and 2012, we saw continued growth through transient demand, even though we saw significant declines in overall occupancy and overall average rate. When you look at the transient average rate side of things, you can see where the fall off occurred. And so transient average rate, hit its peak in 2007 and 2008 here in the orange and the green. Here's where we were in 2012. We expect that we're probably still going to fall shy of that a little bit, particularly here in the early portion of 2013. But perhaps by the end of the year, we'll be able to get back up near the 2007, 2008 levels in terms of ADR for the transient segment.
Okay. And that's transient as opposed to group or corporate?
Yeah, so this is individual traveler, so we don't have a breakdown on leisure or versus commercial traveler, unfortunately. But this is just the individual traveler when we're talking about transient demand. And then on the group side, again, looking at the purple for 2012 and then where we were in 2007, 2008, you can see it's a little bit of a mixed bag in terms of demand, but overall we're still below, in most months, overall group demand here in 2012 versus 2007.
But close to it, very close.
Close, it's close, yes. I'll show a slide in a little bit here that'll really illustrate the variance between transient and group demand a little better. And here we're looking at group average rate. Again, you can see group average rate is well below what it was at the peak in 2008 when group rate was obviously fairly high. And you can see, really group rate comes back late, group demand and group average rate come back a little bit slower than transient, just because that market segment lags the industry generally 6 to 12 months because of the booking time frame and getting budgets and all that in line for having larger conferences or inviting more people to conferences. So a lot of that is really more dependent on corporate profits as well. And then looking at average rate growth month over month broken down for the transient segment, you can see we had fairly significant growth in 2011, but that growth in ADR has actually slowed in 2012 from 5.1% for the year in 2011 to 4.2% in 2012. And you can see a lot of that is really driven by, demand growth is starting to reach a capped level here in the transient segment, and the growth really needs to come from the rate side of things, but we're not really seeing that in terms of huge year-over-year growth numbers for either segment. When we get into the group ADR, this is even more telling when you can see that group ADR has seen essentially inflationary growth for the past couple of years during this recovery cycle. So we're still lacking any robust group ADR growth. And again, this is really one of the key issues that I think is really burdening the industry and preventing, even more robust growth for our industry as a whole. And then, as I said, when you look at numbers like this, comparing transient and group demand is actually below what it was at peak, whereas transient demand, we gained 30 million room nights in demand since the peak of the market. So it's very telling to see the difference in growth in these two different segments, where you would expect, at least some growth on the group side of things, simply because there are more hotels opening, and that that's really what we're seeing in a lot of the transient segment, where the growth in rooms or supply has been in those upper mid-scale and the mid-scale segments that aren't really group oriented, and because those rooms are
generally limited service
now being filled, so they're being filled primarily with transient demand. But the group demand, has really been hurt, and some of this could be related to the AIG effect, the GSA, a lot of different issues behind the scenes that you really can't put your finger on as a number what the impact is overall on those issues. But certainly there seems to be some degree of impact that's hurting the group segment.
And now we wonder if the government budget sequester might impact group, or at least government group.
Yeah, I
travel.
mean, certainly that could hurt both segments if you're looking at individual travelers as well as group for those for what might happen with the sequestration.
Yeah.
Here's a look at the overall U.S. or continental U.S. anyway, and what we've mapped here is the RevPAR recovery through the end of last year. So we're looking at every individual market tract within the U.S., so about 600 market tracts, and we've color-coded them based on whether they're above or below their prior RevPAR level peak, whenever that may have occurred. For some of these markets, it may have been in late 2007, and others it may have been late 2008. But what we're looking at is anything in the green is above prior peak, and anything in the red is below prior peak. And obviously the darker on either side of that means that it's farther above or farther below that peak. Now, breaking it down into those that are already fully recovered, you can see there's obviously a lot of green here. And some of the things to point out is that the majority of this is not in those primary urban locations or primary resort markets. A lot of this is really middle America and tertiary locations that generally a lot of Wall Street banks or investors aren't really prone to investing in. There are some pockets here that you can see some of the major markets that have seen
San Francisco,
a full recovery, and certainly
San
Francisco, a good portion of Denver, parts of Boston,
Miami
Houston has certainly seen a big portion, and certainly areas Miami and Tampa down there. But overall, it's really not the locations you would expect that are seeing the enormous growth coming out of the recovery. And certainly the darkest area you can see up north there in North Dakota, and again, that's really driven by a lot of the fracking that's going on there with the
energy
oil
business.
industry.
Yeah,
it's really driving that.
So the darker green indicates a larger recovery?
Yes, so the darker green you are, the higher you are above your prior peak RevPAR.
Okay.
And flipping that around and looking at the markets that are still lacking, you can see that a lot of this is really related to many of those markets that were hit hard from either in the group segment or from a lot of the resorts, particularly when you look at Southern California, Las Vegas, Phoenix and Tucson areas, and certainly a lot of the resorts in Florida as well. And then you have some other issues that are affecting a few of these areas, particularly when you look down here on the Gulf Coast. You can see some of those areas were still impacted by the Gulf oil spill and issues with that. So there's certainly some factors related to that. And then certainly on the East Coast, there was some impact from Sandy last year that really hindered some of the recovery pace that they had on the books going into the last quarter there.
Yeah.
And then looking at the top 25 markets, and this really breaks it down as to how the industry is so segmented in terms of recovery by market. San Francisco recovered in a quick 3-year time frame. What we're looking at here again is peak RevPAR, when they hit their peak, to how long they have or is anticipated to take until they recover. So certainly, as I said, San Francisco at the top of that, Miami, Oahu, Boston, Los Angeles, and actually I think Los Angeles has really benefited a lot from the new developments downtown, their new convention center and convention hotels that have really helped drive business there. But then you look down at the bottom and you see New York and Washington and Phoenix, and there's been a lot written about how New York is seeing such robust growth in their recovery, but they fell so far that they still are only a little more than halfway back to where they were. And the same thing we're seeing with Washington, D.C.
Is the new supply in New York also having an impact, you think?
A little bit. I think that we're seeing some of that now, but there's still so much new supply on the books that hasn't been realized in New York yet that I think that going forward that's going to hinder their recovery a little more. Yeah. But right now, there hasn't been such a significant increase in supply in New York yet, but certainly that's the risk factor going forward that is likely to continue to hinder their growth, and we don't see their recovery or them returning to their prior RevPAR peak until probably early to mid 2015. Certainly, there are other markets that are still being hurt by new supply, and a lot of that's Orlando saw quite a bit of new supply come in. That's still being absorbed, and they still have quite a few projects on the books there that will probably continue to hinder that market's recovery. Atlanta, I think Atlanta's always been kind of a tough market personally. That's really taken a long time to recover there. But you can certainly see that there's a broad range of time periods and time frames for many of these markets. So when you're looking at the overall industry numbers and seeing, whether it's how good or how bad it is, depending on whether you're looking at it the glass half full or half empty, you can certainly see that there's a big variance between the top 25 markets and how quickly they're recovering in this cycle.
Yeah.
And here, just looking at a quick best and worst in terms of overall ADR change for last year. Certainly, there's stories behind a lot of these. West Texas, driven largely by the oil industry. Oahu, Hawaii took quite a bit of time starting its recovery turnaround. So even though they're seeing a lot of recovery in Oahu right now, they're probably lagging the recovery in terms of time frame that it took them to really start seeing robust growth there. San Francisco still sees significant growth, being one of the strongest markets right now. North Dakota, as I've mentioned, the oil fracking there, or the shale fracking. San Jose and Santa Cruz, a lot of that is driven, by the revamping of the tech industry there, and Charlotte, driven by the Democratic convention that was held there last year. Indianapolis had the Super Bowl, so there's lots of different factors on the plus side there. And then some of the markets that are lagging, really the ones that are easily to define are the Jersey Shore that got hit by Hurricane Sandy.
Right.
Washington D.C. With last year being an election year, that obviously affected Washington D.C. because most people weren't coming into D.C. Everybody was leaving D.C. to go campaign. So campaign years are always a little different in D.C. Particularly when it's a major presidential election.
Now these changes are comparing 2012 to 2011.
Yes, these are year-over-year changes.
Year-over-year, yeah, okay.
And then looking at the same for RevPAR, you can see, certainly West Texas has seen such significant RevPAR growth in terms of year-over-year percent change there with such high demand levels. A lot of these markets are pretty much the same that were shown on the prior sheet. Houston pops up here. Again, they're largely driven by the oil industry there too. And then again, a lot of these other markets tell a bit of a story. I think you look at Louisiana South here too. That's part of the recovery related to the Gulf oil spill that occurred a couple of years ago. So you can probably pick out a few other markets here that have really more of a reason behind their decline, but some of these are just simply weaker markets altogether.
Yeah.
Getting into the investment side of things, STR Analytics has really gotten more into the investment data side of things, and a lot of the acquisitions component to this is really a big thanks to Hotel Brokers International and a lot of the data that you provide us there. But looking at the overall picture for hotel investments in 2012 and where that money went to, about $12.5 billion went into acquisitions and only $6.8 billion went into developments. And obviously the only piece that's missing to this is how much capital was spent on renovations at properties. But this really provides a good picture of where the money is going, and people generally see acquisitions as the way to grow quickly, and as opposed to developments which are really harder to finance still in this environment, even though in some markets they're clearly viable. Yeah.
And do you have any data on what the renovations figure was spent on hotel renovations in the last year?
We don't have a total number for that, no. We are trying to gather that data right now through our host program. That's one of the new pieces of data we're requesting, is to find out how much people have spent on renovations in the past year and where that money has gone to, so that we can try and come up with an overall investment number in terms of capital spent on either developments, acquisitions, and/or renovations. So that's something we're still working on, and hope to have that available probably in the next few months here. In terms of overall transaction volume over the past 13 years, you can see, obviously the curve of the recovery and downturn and whatnot. The big thing to notice here is 2012, how there was, a little bit of a hiccup here in terms of where you might have expected 2012 to end up based on where it is in the cycle. 2011, we saw, almost $20 billion in assets trade, yet in 2012 it fell to about $12.5 billion. And if you look at the prior cycle, you might have expected 2012 to end up more in the $25 billion range. But things slowed down last year for a variety of reasons, I think. Part of it, being related to the fiscal cliff, part of it being related to the fact that, the banks are still under a lot of duress in terms of assessing their risk of new projects, and certainly development financing is a piece of that too. But even financing new acquisitions is difficult if you don't have a very good deal that's in a solid market and cash flowing. And for 2013,
some lenders are still unloading distressed assets or holding on to them, so they haven't come back into the game of financing yet. Maybe that's another factor.
Yes, and some people have said that perhaps 2011 was a bit of a false high in terms of the amount of acquisitions that were done there, because you do have a lot of new REITs that had come onto the market, paying a fairly good price for assets that were cash flowing, and really they had a lot of cash in their wallets to be able to acquire assets, because many of them went public without any assets in their hand. They were just trying to gain capital to be able to acquire assets, and once they filled their portfolios 2012 to a large degree, many of those REITs took time off and were starting to asset manage their portfolio instead of being on an acquisition spree. Yeah.
It's interesting looking at this graph with the 2009 number, comparing it back to 2000 and 2001, 2002. I would have thought 2009 would have been even worse, but because being in the hotel brokerage business, it felt worse than 2001 and 2002, but actually it looks like transactions were a little bit stronger in 2009 than they were in 2001 and 2002.
Yes, and I think part of that is there were assets that were unloaded in 2009 that were fairly high end and that sold at high prices, whereas in 2001 and 2002 we didn't see a significant amount of distressed assets go on the market at all. And we certainly didn't see a lot of.
It was more of a hold period instead of unload. Yeah.
Exactly, and when you look at particularly 2005, 2006, when a lot of the large acquisitions occurred and a lot of those financings occurred, the 5-year time frame on maturity of a lot of those loans occurred in 2009 and into 2010, and so that also drove some of the unloading of assets or recapitalization, if you will, in a lot of those trades. And certainly we're not looking at foreclosures here and bankruptcies, but certainly a lot of that played into it. If the person who took over the property after a foreclosure or bankruptcy decided to unload it afterwards, in that sense, it would be showing up here in an acquisition. And then looking going forward in 2013, for the most part, we're still expecting, a fairly robust year. I mean, even though it's expected to be a little lower than 2011, perhaps, right now we're on a pace for about $17.5 billion, assuming we stay on the pace we're at right now. We're seeing about $2.6 billion in asset trades through February. And we know of quite a few large assets that are expected to trade here in the next couple of months. So assuming that pace keeps hold, we'll end up somewhere between the $15 to $20 billion range in terms of overall acquisitions in 2013. And then here is some data that we have on renovations, but this is only renovations for properties that traded. So we do have data on, post-acquisition renovation data per room here. And you can obviously see that, for the most part, $20,000 to $35,000 per room in renovation costs post-acquisition. Doesn't seem like a fairly insignificant amount, but it's generally what we see in most of the assets that were acquired between 2003 and 2007. Obviously, that fell off quite a bit in 2010 and 2011, and we attribute that to two things. One is there were a lot of assets that exchanged hands in 2009 that were essentially brand new hotels that opened up and couldn't gain permanent financing and then ended up going on the market and being sold. So they didn't need renovation. And then the other piece to that is a lot of the franchise companies being a little more lax in enforcing their PIP requirements during the downturn, knowing that that would be quite an issue for a lot of the owners and certainly the new owners that were taking hold of some of the struggling assets. So now in 2012,
and just the lack of capital also, I would say, for the to do the renovation, to do PIPs.
Yes, certainly that is obviously the key issue, that there wasn't a ton of capital available to be able to do renovations on a lot of these properties. That's exactly right. But here in 2012, we're seeing it peak up in terms of the data we have, that it's close to $40,000 per room, and a lot of that is related to the deferred maintenance, deferred PIP requirements that are finally being enforced in 2012, and certainly, a lot of assets that probably needed renovations a few years ago probably even need more renovation now because of the wear and tear on those assets that further deteriorated over the past couple of years.
Yeah.
Looking at the average price per key over the past several years, you can see that, for the most part, we're back to where we were in terms of what the average price per key is. In 2011 and 2012, we're above what the prior peak was. Certainly, some of that is related to the types of assets that are traded, and when you look at a lot of the REIT trades that occurred in 2011, and even some of those in 2012, they were paying a fairly high price per key for many of those key assets and key markets that had cash flow, and particularly when you look at New York and D.C. and San Francisco asset trades that have occurred from some of the major REITs, they're paying prices that are at or above what the prices were back in 2006, 2007 in many of those markets. And looking at the average cap rate, you can see a trend here, and certainly one thing to note is the little hiccup in 2010 where cap rates actually dropped a little bit and then rose again in 2011. Again, we think a lot of that is due to people paying a higher price than what the cash flow validated in 2010. But here we're actually seeing the trend that cap rates are going down, which has obviously a huge impact in pricing when you think that cash flows are continuing to go north. And what we're looking at going forward is probably cap rates going down a little bit further in 2013 based on some of the data we already have there. Looking at the room revenue multiplier, and for those of you who are familiar with this, is obviously the value or the price paid for an asset divided by its room revenue. The general rule of thumb that I've always heard is that it's typically between 3 and 4, but as you can see, starting in 2006, it exceeded 4, and it is just getting back to the 4 range in 2012. We expect that it'll probably decline a little bit more and probably be just below 4 in 2013, but certainly you can see a very similar inverted trend here when you look at the room revenue multiplier compared to the cap rates, and certainly the room revenue multiplier is more robust in data that we have, since we have the room revenue on probably 99% of the assets that trade here at STR. So, certainly helps us validate what the cap rate data is showing us, since cap rates are a little bit harder to come by, and some of that cap rate data is a little inconsistent. But when you look at the room revenue multiplier, you can basically see the same trend, although it's inverted since you're looking at the room revenue instead of the net operating income.
Right.
And then looking at the top markets in 2012 and what people were paying on an average price per key level, obviously you can see New York, very substantial. People still want to pay up to have assets in New York. They see that as the primary urban market, and even as you saw, the recovery cycle in New York still has 2.5 years to go. The pricing is already back, if not above, where it was at the prior peak. And then the other top markets, obviously Boston, Washington, San Francisco, no surprise there that they're near the top. San Diego and Los Angeles have really gained a lot of momentum and a lot of cachet over the past few years there, and I think that we're going to continue to see those grow in terms of where people want to buy assets. And then near the bottom here, really in Tampa, Nashville, Dallas, probably not too big of a surprise there. It's not that these are necessarily bad markets to invest in, but you're just seeing the overall price per key that people are paying there is obviously a lot lower and a lot cheaper to get into those markets than some of the other major markets.
Steve, I'm just wondering, how closely does the average price per key of transactions in these markets correlate with the ADR in those markets?
We've looked at that and tried to find some trend that was easy to identify, but really, other than the fact that New York is the top ADR and New York is the top market here in terms of average price per key, that's really the only thing that is simple to point out, because in a lot of these markets, it's really driven by different dynamics, more related to the types of assets that are trading and where those assets are trading.
Yeah.
Because Washington, D.C. isn't really all that far behind. At least Washington, D.C. isn't probably all that far behind New York either, but in terms of what people are paying to get into those markets on a per key basis, it's a bit lower than New York. So there really isn't a direct correlation between ADR, even RevPAR, for these markets compared to their average price per key. I mean, certainly there's some semblance of Dallas has a much lower RevPAR than perhaps Chicago, but the variance, it's not a simple formula to create.
Yeah, well, I guess
price per key.
It depends whether there's more luxury hotel assets trading or more economy or budget properties trading, and that's going to vary the number a lot.
Yeah, exactly. You're not really seeing apples to apples in a lot of these markets. I mean, certainly New York has a lot more luxury assets to trade than, say, Nashville does. So there's some inequalities there when you're looking at this chart even. And then breaking it down by segment, you can see the 2012 deal stats and where we are on a price per key basis and room revenue multiplier for each of these segments. Obviously, no surprise that the way these things trickle down from the luxury to the economy and what the price per key is. And the room revenue multiplier is obviously higher for the luxury assets than the assets below it. But and certainly a lot of that is because there's more revenues than just the room revenue on a lot of those higher end hotels. So it's not just the room revenue that's really driving some of the factors as far as what people are paying for those assets. But what you can see is where a lot of these deals are occurring. The upper upscale segment, I think people are buying a lot of the Marriotts, Hiltons, Westins, those types of products at a fairly discounted price when you look at $189,000 a room compared to what it would cost to build that type of property. And the same with the upper mid-scale. It seems like people are paying a fairly high price, even though there's been a lot of trades in the upper mid-scale segment. For $105,000 a room, on average, that's a fairly high price, I would think, for the Hampton Inn, Fairfield Inn type family of products.
Yeah.
And just a quick look at some of the top deals from last year. Probably no surprise here that most of these are in New York, D.C., California, or San Francisco rather. And the other thing that jumps out in a lot of these is really, for the most part, they're independent properties. When you look at the Plaza, even the Essex House being with Jumeirah, the Manhattan at Times Square, that used to be the old Sheraton there off Times Square, and then the Dream Hotel, which is more or less a fledgling brand at this point. And then this is a survey that we do with Hotel News Now called the Hotel Investors Gauge that we do each quarter. And at the fourth quarter of 2012, this is what most people, or the average that people who participated in our survey showed as their underwriting criteria and where they're going with assets. So for the most part, people are underwriting 5-year deals in their underwriting. Their leverage IRR is about 18%, which is really what a strong year would be for the hotel industry for what people are return expectations are. And then the cap rate on trailing 12 months NOI, what they're said they were underwriting at the fourth quarter of 2012 is actually lower than what was realized in 2012. So this is one of the reasons that we expect that cap rates are probably still going to continue to trickle down a bit. We saw 9.2 in 2012, and we probably expect that it will be 9% or below in 2013.
Mm-hmm.
On the
one thing I've seen in hotel brokerage in the last couple of years, you'll see people sometimes pay what would seem to be a price that indicates a very low cap rate for a distressed asset, but knowing that they can come in and reposition that asset and get a big upside, reduce expenses, increase revenues, renovate, et cetera, sometimes change the brand. And so I think partly that lower cap rate might be an indicator of distressed transactions that are still happening. And even though it's distressed, sometimes it's then being sold at a low cap rate because just due to either distressed capital or distressed management, there's a big upside, and the buyer's willing to buy it at a lower cap rate and then reposition it.
Yes, I certainly agree with that, because a lot of times we're looking at the cap rates on a trailing 12-month basis here, because that's honestly the bulk of the data that we're able to use, and that way we're able to do an apples-to-apples comparison. But certainly, the repositioning opportunities or opportunities where people are buying a struggling asset that is anticipated to either grow with the market or improve with increased management, new branding, et cetera, that it certainly doesn't take into account all those factors and what people are looking at going forward.
Right.
Looking at the development side of things here, here's a look at all of the new hotel rooms that have come in the past 13 years and what's expected for 2013. And as you can see, this is total number of hotel rooms. You can see that 2011, 2012, significantly low. And even with a little bit of a spike here in 2013, we're still only slightly below the growth that we saw in number of rooms in 2004, which was the trough of the prior cycle. So I think that this is one of the key fundamental factors that people look at in the lodging industry and see it as a big benefit, at least for the short term. But when we get into the long term, we'll see that there's probably we're obviously coming out of the cycle, and we're going to see more development going forward. And looking at it by segment here, you can see, and I kind of relate this to the prior chart that we showed in terms of what the average price per key was in these segments. But what we've come up with is a hotel development index that really indicates, what the replacement cost per key percentage is, or development, or not, I wouldn't say feasibility, but development risk is in some of these segments. And so what we're looking at here is the average price per key on the right-hand side compared to the average cost per room for these segments. And you can see the upscale and the upper mid-scale segments are the ones that have the highest ratio here, indicating the lowest amount of risk because their cost is lower or slightly above what it is for the average price per key. So I think that's where we're seeing a lot of the new projects come in, is that people are paying such a high price for the upscale and upper mid-scale products compared to what the cost is, that it makes more sense to develop those, even though there is a 12, 18-month lag time in terms of actual construction time for that. So that's, again, where we're going to expect to see the growth continue is in those segments, particularly when you're looking at some of those more fledgling brands that are trying to build up, like the Aloft and High Place products. I think we're still going to see that for the next 2 or 3 years, that those segments are going to be really areas of focus. I mean, certainly you can probably build a luxury hotel, I think, if you can get the financing for it, because, I mean, as we saw, the average price per key was over $460,000 a room. I would hope that somebody could build a luxury hotel for less than that. So certainly it's feasible, but is it likely that you're going to get financing for more risky project that in terms of the lag time, because certainly the luxury assets take a little more time to construct than the upscale or upper mid-scale. So might be talking like 2.5 or 3 years for some of those assets to get constructed. And looking at the major brands that have come into the market in 2012 and who added the most rooms, probably no surprise that Hampton Inn Suites is on top, Holiday Inn Express just behind it. Certainly those in the upper mid-scale segment, and a Hilton Garden Inn Courtyard, quite a ways behind that, but still in 3rd and 4th place here. And those two are obviously in the upscale segment. Looking at the construction pipeline, really you look at a lot of negative numbers here in terms of year-over-year change, and that's really all in the planning and pre-planning process where a lot of the negativity is. But what you can see is a big positive in properties that are under construction year over year. That's a 25% plus growth there under construction, and we expect that to continue to pick up in 2013 and 2014. Here's where the bulk of the pipeline lies that we have on our books right now at STR, and this is not just for 2013, but overall going forward. And you can see a lot of the major markets here. No surprise that up in New York, you can see a lot of large dark bubbles. Certainly the same thing in Las Vegas. There's still a lot of projects on the books there. A lot of those got mothballed during the recession. But certainly
so
some other
each
markets.
Bubble is a project, and the larger ones are bigger dollars? Is that?
Yes, the larger and darker the bubble is, the larger the project is. So when you're looking at like Denver, for instance, there's still a Gaylord project planned there. You still have a lot of large bubbles in North Dakota that are planned up there. You see a big bubble right in the middle of Texas. That's Austin. That has quite a few projects under development downtown. So that's really one of the key, I guess, secondary markets that we're seeing a lot of growth in. And certainly you can see Florida, particularly around the Orlando and Central Florida area, that there's quite a significant amount of growth anticipated there. And these are the actual under construction rooms, very similar to a slide I'd shown earlier with year-over-year growth for 2012. But here we're looking going forward on number of rooms that are under construction as of today, and obviously that's in the upscale and upper mid-scale segments that we're seeing the most significant growth here, with very minimal growth in the luxury and upper upscale segments and almost negligible growth in the economy segment. And then here we're seeing how the growth pace is picking up to a large degree, and we're looking back at what the reported projects were over the year end for the past 3 years, and what was on the books and what was coming in 2 or 3 years out. And obviously we can see more of those projects moving up to reality in the 1 and 2 years out in 2012 compared to what we were looking at in 2010 and 2011. So even though there's fewer projects 4 years out or more, there's more projects that are being moving up into the 1 and 2 year time frames. Again, part of that is a result of the segments that are seeing that growth, and that's again the upper mid-scale and the upscale segments that are really an 18, 24 month time frame to construct. And looking at the major developments from last year. Certainly, on the luxury segment, really the biggest project of any was the St. Regis Bell Harbor, the redevelopment of the Sheraton Bell Harbor. A lot of that had to do with residential development that occurred there too, with 268 condominium units, but the $1 billion redevelopment project. Disney, obviously, they continue to add properties there. $350 million for their Art of Animation has opened up, and then the Hilton Columbus, which was actually the only convention center hotel that opened up last year. Obviously, we've seen that trend in a lot of markets with Dallas and Los Angeles adding in recent years, and there's still new ones under development. We see one in Austin that's going up again, and Indianapolis had one that opened up a couple of years ago too. So even though that's been the trend, the Hilton was in Columbus was the only one that opened last year. And then with that hotel investors gauge, we also asked developers what their underwriting criteria was in terms of what they're looking at. And one of the things that really jumped out was their hold period after completion. Over the past 2 years that we've been doing this, really the hold period past completion has been somewhere within the 3 to 5 year range, because most of these developers wanted to build, benefit from the uptick over 2 or 3 years and then flip the asset. Now it looks like a lot of the developers are realizing that flipping it in 2 to 3 years might not be a good time frame, particularly, as I'd shown earlier, there might be another hiccup in the market in 4 years or so. So they're underwriting for a longer hold period after they're completing their development. And then the leveraged IRR at 25.5% is actually still a little high than what a typical development might be. We've seen during the stronger periods in the marketplace that development underwriting has shown leveraged IRRs in the 22 to 23% range. So still a little higher, still more risk here from a developer's perspective on hotels.
Mm-hmm.
And then again, with our survey, one of the things that we asked was what the anticipation was for occupancy and average rate growth of the industry in 2013. 57% of the respondents expect occupancy to remain stable in 2013, essentially saying that they don't see significant growth and they don't see any decline in occupancy either. So certainly there's good and bad to that aspect of it. On the ADR side of things, 87% expect moderate growth, and we did ask if they anticipated strong growth or even excessive growth, but most expect it to remain along the same lines it is now, which is 3 to 5% ADR growth year over year, which again relates to what I had said earlier about not seeing the 7, 8, 9% year over year ADR growth rates that we had seen during the prior cycle.
Mm-hmm.
And then looking at our projections at STR for 2013 and 2014, obviously we're seeing supply pick up a little bit this year. I think we finished up at 0.5% in 2012 in terms of year-over-year growth. 2013, we're seeing 1% supply growth, and in 2014, we're expecting 1.5%. But again, that's still below the long-term average in year-over-year supply growth, which is around 1.9 or 2.0%. On the demand side, we actually expect demand to continue to grow, but at a slower pace than what we saw this year. And then in 2014, we're actually expecting to see demand grow a little more because we're anticipating new assets to open up and a lot of that new supply be absorbed by unaccommodated demand in the marketplace. In the same, you can see that with occupancy too, where we're expecting slower occupancy growth in 2013, but in 2014, we expect with the new supply that we can see a little more occupancy growth in some of those markets.
Steve, I'm just curious on the supply side. Do you predict the retirement of older hotels out of the market or out of the supply, or when do you take a hotel that's been operating out of the supply?
We do anticipate some attrition to that. Certainly we do that for both our pipeline. So we anticipate that there's going to be some projects that either get deferred or don't come to reality. And we do anticipate that there will be some assets that become obsolete and are either redeveloped or torn down or have another use. So that is all factored into our supply growth number.
Okay. Good.
And then on the rate side, we anticipate 4.9% growth this year, slowing a little bit in 2014, and I think a lot of that is just a result of the types of assets that are coming into the market with lower room rates in a lot of those areas. So it's really not a reflection on the industry's ADR slowing because of, say, the fundamentals of the industry, but really more of just the factors of the types of assets that are coming into the market at a lower rate than what the market currently has.
Yeah.
And then obviously the resultant of that is the RevPAR growth, where we're expecting to see 5.7% in 2013, and even higher growth rate in RevPAR in 2014. So that's all I have, and I don't know if anybody else has any more questions, but if anybody has anything they'd like to email me afterwards, feel free to do that. And otherwise, thank you very much for having me today.
Yeah, thanks, Steve. We greatly appreciate the data and your presentation and your wisdom and perspective on the hotel industry fundamentals and the transactions and the outlook. I'd like to remind everybody to rate today's webcast by clicking on Rate, which is found on the gray bar located at the top of the webcast player. You can also download a PDF list of today's featured hotel listings, plus a selection of additional hotel investment assets listed by HBI brokers under the Attachments button on the top of the webcast player. As a reminder, this and previous Hotel Investor Marketplace webcasts are also available for on-demand viewing online at hbihotels.com. HBI will be exhibiting at the Hunter Hotel Investment Conference in Atlanta on March 20th to 22nd, and HBI will also exhibit at the AHOA Annual Convention and Trade Show being held in Houston on March 27-28. If you're attending either of those conferences, stop by and visit us. At the AHOA conference, we'll be at booth number 744. HBI brokers look forward to seeing you in the marketplace. And again, thanks to Steve Hennis and Smith Travel Research Analytics. Have a great day, everybody. Thank you.